What if you could buy a home here in Tucson and take over someone's mortgage rate from years ago? Not refinance it, not negotiate it, just take it over. It's called an assumable loan, and most buyers, honestly, a lot of agents too, don't even know it's an option. Right now, that's a genuinely big deal because the gap between where rates were a few years ago and where they are today isn't small. And if you're a homeowner sitting on one of these loans right now, stay with me because this might be the biggest selling point you didn't know you even had. Before we get into the details, stay with me because later in this video, I'm breaking down 3 real transactions our team handled, 2 of our listings and 1 buyer purchase. I'll show you the assumable VA loan terms, compare them with what a buyer would pay at today's conventional rates, and walk you through the monthly payment difference. The savings are significant, truly amazing, and the actual numbers may surprise you. Okay, one quick thing before we get into it. If you've been watching this channel for a little while and you haven't hit subscribe yet, it would really mean a lot. It really helps the channel grow, and I've got more of these market breakdowns coming. Okay, let's get into how this actually works. So here's the plain version. An assumable loan means a buyer takes over the seller's existing mortgage. Same rate, same remaining balance, same remaining term, instead of going out and getting a brand new loan at today's rate, because let's be real, it's kind of scary. Let me put real numbers on this situation because that's where it actually clicks. Say a seller locked in their rate back in 2021 at 2.75%. A buyer today is looking at a loan something closer to 7%. On a typical loan size here in Tucson, that difference isn't a rounding error. It's hundreds of dollars a month and tens of thousands of dollars over the life of the loan. So that's why assumable loans are getting attention again. For years, nobody talked about them because rates barely moved. Now the gap is big enough that it's worth understanding. Stick around because I'm going to tell you exactly which loans qualify for this. And there's one thing that can quietly complicate the whole deal if nobody checks it first. So which loans actually qualify? Let's break it down. So not every loan is assumable. In fact, most aren't. Conventional loans, the most common type out there, almost never are because they have what's called a due on sale clause. That basically means the loan has to be paid off when the home sells. The 2 you're looking for are a VA loan or an FHA loan. With a VA loan, here's something a lot of people get wrong. The buyer does not have to be a veteran to qualify and assume it. That surprises most people. But the lender still has to approve the assumption. It's not automatic. Typically, 60 to 90 days, so timing flexibility on the buyer's side really matters here. Here's the nuance that matters most for sellers, though. If a non-veteran assumes your VA loan, your VA entitlement, the benefit that let you get that loan in the first place, can stay tied up unless the buyer is also an eligible veteran willing to substitute their own entitlement. It's not a deal breaker, but it's something you need to know going in because it can affect your ability to use a VA loan again down the road. FHA loans work a little differently. The buyer still has to qualify with the lender based on their own credit and income. It's not just a handshake and a signature, but there isn't that same entitlement complication. Now here's the catch, and this is the part that trips people up. If the home has appreciated in value or the seller's already paid down a good chunk of the loan, there's a gap between what's still owed and what the home is actually selling for. Say the loan balance is $280,000, but the home is worth $400,000 today. That $120,000 gap doesn't disappear. The buyer has to cover it in cash or by layering in a second loan. And again, lender approval isn't automatic. The buyer still has to qualify on their own income and credit, the same as they would for any other mortgage. So is this a shortcut for everyone? No. It works best for buyers who have a solid down payment ready or sellers whose loan balance is still close to market value. And it works best when the buyer has flexibility on their closing date, since this process moves slower than a standard closing. That's actually part of why we work with a lender who specializes in assumable loan processing and has closed every one they've taken on, because a process like this really benefits from someone who knows it inside and out. Now, if you're watching this as a homeowner, here's why this actually matters to you. If you've got a VA or FHA loan from a few years back, there's a real chance you're sitting on a rate that buyers simply can't get anywhere else right now. Across Pima County, That's becoming a differentiator between listings that sit on the market and listings that move. That's not just a nice detail, that's a competitive edge. It can make your home stand out against every other single family listing in your price range, especially in a market where buyers are watching every dollar of their monthly payment. And if you've been sitting on the fence about selling because you didn't want to give up your rate, I'd actually flip that thinking. That rate might be exactly what sells your home and exactly what gets you a stronger offer. It's worth a real conversation before you rule it out. Let me take you back to May 2024. My buyers found a home in Catalina on Rodeo Buckle, priced at $365,000. What made this one especially interesting was the financing. The seller had a VA loan at just 3.5%, and because VA loans can be assumed, our buyers were able to take over that loan instead of financing the home at the much higher market rate available at that time. Now, look at this. In May 2024, the average conventional 30-year fixed rate was 6.94%, nearly 7. My buyers assumed at 3.5. Their loan balance was $290,000. At 3.5%, their monthly principal and interest came to $1,302. Add taxes and insurance, total PITI $1,791 a month. But if they'd gone conventional at 6.94%, same loan balance, same house, their monthly P&I jumps to over $1,900. That's a difference of $612 every single month. Every single month. $7,300 a year. Over 30 years, $220,000 they'll never pay, all because they assumed a loan instead of originating one. Now let's move to October 2024 and a completely different property in Sun Lakes. Our buyers purchased a home on Beech Creek Drive for $550,450. What made this transaction especially valuable was the seller's existing VA loan. The interest rate was just 2.75%. At that time, the average conventional mortgage rate was around 6.19. So the difference was 3.44%. The buyers were able to assume the seller's remaining VA loan at $313,000 at the 2.75% rate. Here's where you can really see the impact. Their monthly P&I payment on the assumed loan was about $1,278. Had they financed using a conventional mortgage at 6.19, that would have been $1,900 per month. That's a difference of approximately $636 every month, or more than $7,600 a year. And when you extend that difference over the remaining life of the loan, the potential savings approaches $229,000. Of course, they still had to cover the difference between the assumed loan balance and the purchase price. But because they had the funds available to do that, assuming this loan gave them a much lower monthly payment and a significant long-term financial advantage. Now let's look at the most recent example from July 2026, this month. Lago, Verde in Vail. The home sold for $375,000 and the seller had an existing VA loan with a 2% interest rate. At the time of this recording, conventional rates were around 6.58%. That created a 4.58% difference, the largest gap of the three transactions. The buyers were able to assume approximately $277,000 of the seller's remaining loan balance at that 2% rate. Their monthly principal and interest payment came to about $1,025. Financing that same $277 with a conventional at 6.58 would have put that payment at about $1,766 a month. That's a difference of $741 every month, nearly $8,900 every year. That adds up to $266,000 in savings. Now, there are additional details involved in every loan assumption, including qualifying with the loan servicer, covering the difference between the loan balance and the purchase price. But when the buyer has the funds and the numbers line up, the benefit can be substantial. And remember, these weren't three versions of the same deal. They were three transactions our team handled, 2 listings and 1 buyer purchase at different price points in different markets, all showing the value that you can get with an assumable loan. If you're a seller with a VA or FHA loan and you're curious what that could mean for your sale, let's talk. My contact info is right there in the description box below. And if you're a buyer wondering whether a home you're looking at has an assumable loan attached, or you want help finding one that does, message us. We can put together a list of homes with assumable rates for you to look at. Are you a seller sitting on one of these loans? Maybe you don't even know it. Or a buyer hoping to find one? Tell me in the comments. I read every one because who you work with matters. Believe it.